What's happening, everybody? Future CFA charter holders. That's right. I am talking to you. We are definitely on our way. Today, it starts our journey to a CFA. So what do we have today? Well, I guess there was a mock exam, and unbelievably, there was not a score of 100%. Can you imagine? But the good news is you make the mistakes here, you won't make them exam day, so it's all good. You learn from your mistakes. There's no better way to prepare for this exam, honestly, than to obviously practice your questions. But as you'll see in a minute, one of my key recommendations is to always make sure if you get it right, you got it right for the right reason. But when you get it wrong, let's learn from our mistakes so we obviously don't repeat them. So this is our live lab. I love the name lab. I feel like I'm going to dissect somebody, dissect a future CFA charter holder. Too funny. So let me introduce myself. My name is Peter Olinto. If you've heard of Jack of all trades, you are about to meet his cousin Pete. That's right. So I am a CFA charter holder, very proud, but I'm also a US CPA. That's where I started my career. From there, I went on to law school. My big thing was going to be a tax attorney. Then I wound up having my own practice, and lo and behold, a lot of my high net worth individual clients, because I was a CPA and a JD, they figured I knew all about portfolio management and I could be a financial planner for them. But yeah, was not the case. Certainly needed more education. So that's when I decided to sit for the CFA. And I'm very proud to say that I have never failed any of the levels, nor did I fail any of the 4 parts of the CPA exam, nor did I fail the bar. I passed every exam I ever took on the first attempt. But you know what the good news is? If we had a two-tailed distribution of the IQs on this call right now, I can guarantee you my IQ is probably in the left tail, but my work ethic is in the right tail, folks. And that's the difference between passing and not passing any of these exams. Having a good plan, being willing and able to make that commitment. CFA to me was harder than the bar of the CPA, because you can't sit for the CPA unless you have an accounting degree. So the vast majority of that content I had seen before, and it truly was a review when I reviewed for the CPA exam. Bar exam, same thing. Vast majority of the law that was tested on the bar, I had seen in law school. CFA is its own animal because there's a lot of content for one reason or another that you may not be reviewing. Truth be told, you might be learning it for the first time with us, which is okay. That's to be expected. We have lots of finance students in the U.S., never mind IFRS. They avoided learning financial accounting at all costs, so they don't even know U.S. GAAP. So we got you covered. Everyone's got their strengths and weaknesses. The beauty of the program is this software is set up in a way, and the technology, that where you're stronger, obviously you can get through that content a little bit faster. And the way we're going to gauge whether or not you're strong or not is not based upon what you did in school, but based upon how you're doing the questions in the software. Because I was thinking, accounting's going to be a breeze for me. I was already a CPA. I was already teaching CPA exam content. I was a college professor. So I figured, I'll blow through the accounting. But lo and behold, I knew accounting from an accountant's perspective, not necessarily from an analyst perspective. And so nonetheless, I had a lot of studying to do for the accounting anyway. So the moral to the story is you can and you will do it if you're willing to put in the time and effort, which we'll talk more about. So really, we're very proud at UWorld. Our history starts, and next time you go visit your doctor, ask them who they took when they took their medical boards, either to get into medical school or, more importantly, to get their license, USMLE. UWorld is the course they're taking. Then parlay that into pharmacy, bar review, CPA, CFA. So it's really the approach here is second to none. And I'm 30 years in the industry, and I've worked with many companies teaching both CPA and CFA. And if you ask me, nobody does it really quite like UWorld does. I think there's a song that has that line in it, but it's the truth. And I'm glad you're here because, look, we try on our clothes, we take cars for test drives. Passing or not passing this exam is going to affect the trajectory, not just of your professional life, but your personal life. Because trust me, you're a CFA charter holder, you're going to have a lot more options, and probably for a lot more money than you would have had otherwise. So obviously that's going to bleed over into your personal life. So it's I'm glad you're here. You're doing your due diligence. You sample everybody. Hey, you know what? What's going to be the best fit for me? And that's going to determine, obviously, the course you're going to take. So obviously today we want to review the most missed questions. But beyond that, I want to show you how this content becomes far more manageable when you see that they're not just a bunch of disjointed, 18 disjointed topics. Far from it. Like a lot of what you learn in quant, you'll apply in portfolio management. A lot of what we do in accounting, we'll see again in corporate finance or in debt and equity. So I want to kind of show you how we bring those topics together so it becomes far more manageable. I mean, the authors, God bless them, they write their individual topics, but they don't collaborate. And sometimes the explanations at the end of the chapter are not the best in terms of, it may say why the right answer is right, may not say much about why the wrong answers are wrong. And I don't know about you, but when I get something wrong, I want to know why the answer I chose specifically explain why the one I chose was wrong. So UWorld does a phenomenal job at that. I'll show you that with our detailed explanatory answers. But I do want to start with my study tips. Okay, CPA, CFA, bar exam. Do not underestimate the time and effort you're going to have to put in. I'd rather have you be over-prepared and have you have an incredible foundation that you build at level 1 than barely pass level 1. As a matter of fact, that's a disaster. You're better off failing level 1 and repeating it and mastering it than to barely pass it. So look, 300 hours is an average. I mean, when you're an A student, a B student, or a C student, how many classes did you have in accounting? Did you have a class in forward, futures, options, swaps, real estate, hedge funds, mutual funds? The diversity of topics, is incredible. I mean, how many accounting classes? Don't tell me about intro to financial or cost of managerial. Did you have intermediate 1, intermediate 2, advanced accounting, right? So, again, when you put together your study plan, 300 is a benchmark. Realistically, can you give me 10 hours a week? I think you can. Saturdays and Sundays are great times, 4 hours Saturday, 4 hours Sunday. So if you're giving me about 10 hours a week, you're looking at approximately 8 months. All right, maybe a little bit less. Obviously, you double that, you're going to give me 4 months. But to try to prepare for this in a month or two can be done, but you're an outlier. The average candidate is definitely spending, 4, 5, 6 months or more preparing for each level of the exam. Yeah, that's right. So tell your significant other when you pass level 1, return the cake. It's going to get stale. I got 2 more levels to go. And, level 1 really around the world can have some impact, a significant impact. I know in the US and a lot of places, though, passing level 1's nice and level 2, but the goal obviously is to get the charter. Okay, folks, when you practice, I'm not impressed with volume of questions. Why not? You would think there's a high correlation between the volume of questions worked and your probability of passing. If you're not learning from your mistakes and you're just cranking through questions, I mean, what's the point? We see no improvement, right? So UWorld looks at kind of on a sliding scale. Hey, the better you do, the less questions you have to practice, and you're not doing as well, you're going to have to practice more questions, right? So we look at those 2 metrics, but really what I want you to do is learn from every question. What is the rule being illustrated? If you get it right, great. Just make sure the time you spent is appropriate and you got it right for the right reason. Obviously, it's when we get it wrong that we're going to learn. Okay, so when you get it wrong, to me, there's nothing like engaging in the senses, boy, not typing. There's lots of research that shows when you old-fashioned writing, what you write, you will remember, transfers that information from short-term to long-term memory so that you can better understand that information as well. All right, so put the pen to the paper and occasionally speak it. That's right. So if it's a very important DuPont model, what's the formula? Okay, 5-stage, 3-stage DuPont model. Great opportunity. Speak it out loud because hearing yourself saying is going to help you retain that. As a matter of fact, you want to gauge the quality of your relationship with your significant other? I suggest during dinner, you explain to them the DuPont model. Because if they're still there at the end of the dinner, either they got serious psychological issues or you really did find your soulmate. But engage those senses. Write it. Reading it and watching it is nice. But folks, it's like going to the gym with me and watching me on the treadmill. That's not going to do much for you, right? So obviously get on your own treadmill, put the pen to the paper. Cumulative reviews, folks, are a must. A third, and then your final review. So folks, I cannot have you study something in week 1, 2, or 3 and then not look at it for 3 or 4 months. Out of sight, out of mind. You get done with a third of the curriculum. Stop before you go on when you put together your study plan. That's where you're going to say, well, I got to review the first third. You get through the next third. Then you're going to do a cumulative review, but of not just that third, the first 2/3. All right. That's how you're keeping this information fresh. And that's why it takes closer to 8 months, because you're going to be having these weeks in between where you're not learning anything new, but you got to maintain the information that you've already learned. Now, the beauty is What we do in the course is we constantly remind you formulas that were introduced in one section that are going to be used in another will cross-reference. So again, it makes that information far more manageable because it's not as voluminous as it seems. Speaking of your final review, the last few weeks, for some people, it's as little as 2. For some people, it's a month. I don't want you learning anything new. This is where you're starting off. You're going to do that, you cram course with us, summarize, we'll highlight, prioritize the key concepts. Then you'll start doing your mock exams and exam conditions. Now you have to do 8 mock exams, generally, 3 mock exams, maybe 4 mock exams. But the mock exam is not just there to review the content. That's part of it, but it's also the process of sitting down for that 4 or 5 hour period. What is it? 2 hours, 4.5 hours plus the break. You're looking at close to 5 hours. You can't afford to get anything wrong exam day because you got mentally fatigued in the last half hour. Can't have it happen. All right. The last question you work is just as important as the first question. So it's a mental marathon, baby. That's right. And this is a skill set we got to build up. I mean, the biggest impediment to passing any exam today is the damn phone because we're constantly checking email and text and everything else, man. No. I need complete, undivided attention so that you can focus and build up that concentration. Okay. So, some of the lowest scoring topics, and again, it was just on this particular mock. They vary by mocks, but, obviously fixed income is heavily tested, and it's heavily tested at all 3 levels, as is portfolio management. Corporate issuers, you're going to see both in levels 1 and 2. Now, ironically, sometimes the more math-intensive topics, depending upon your skill set and your comfort level, they sometimes the formula. And to me, there's nothing better than a formula because once really you learn the formula and understand it, I'm going to get almost every single one of those questions correct. What's interesting is the theory, specifically the ethics. Oh my goodness. I don't know what it is, but I mean, I talked to so many candidates and some of the hardest questions in levels 1, 2, and 3 were the ethics. And I mean, by far, it was, so again, more straightforward topic. Sometimes the questions could be really challenging. Okay. So don't underestimate some of the theory concepts because they certainly could be challenging. And by the way, more than half the time during the exam, you will not be picking up your calculator. That's right. Because even math intensive topics, they've moved away from mere, memorization, current ratio. What are they going to, they can make you calculate it. But, if you see the current ratio and it's changed over the past 5 years or how it's looking as compared to the major competitors in the industry, can you assess, does that mean greater risk, less risk, etc.? Hey, if I pay off this debt early, is that going to improve my ratio? Will it deteriorate? Whatever it may be. So a lot of times, even with the math intensive topics, they want to make sure you understand it and haven't merely people spend hours and hours memorizing stuff and fail, the CPA as well as the CFA because they really don't understand what they're calculating. All right. So that's why the slow and steady here wins the race. So again, the learning modules where people struggled, that corresponds to the topic. So it is what it is. A lot of times, different mocks. It could be the accounting questions. It could be the derivatives, whatever. Here, this is what we have. So this is what we'll work with today. So, corporate governance, as I mentioned, it's, some of it's theory, some of it's math. At level 1, you've got a lot of your weighted average cost of capital, net present value, IRR, capital budgeting is huge. But some of the questions here weren't math intensive. We didn't ask you to calculate WACC. We didn't ask you to calculate NPV or IRR. So they were more theory based, which created some problems. Fixed income, no surprise. Look, if you're a fixed income analyst and this is a strength for you, wonderful. A lot of people are not. So, we have equity analysts who, just for whatever, that's not their thing. And we have people who trade derivatives, etc. So, not a big deal. We're going to teach you exactly what you need to know, but in a way that you're going to understand in plain English, getting away from all the flowery language where they like to, if we use language nobody understands, premium or discount. Well, it's a gain or a loss, really, but you could call it whatever you want because we just don't want people knowing what we're talking about. So that premium or discount's going to get amortized. What the hell does amortize mean? Well, that just means we're going to record it over time, spread it out. We can't record it right now because that would violate something called the matching principle. But we got to use our code language, right? But in class, we are going to speak plain English so we can understand this damn stuff. And risk management, portfolio management, understanding your client. Every client has unique needs and circumstances. That means treating clients fairly doesn't mean to treat them the same. because they all have different levels of risk aversion. And most clients don't want to assume any risk for which they're not rewarded. So a lot of level one looks at, hey, how can we diversify away that risk? And this is where I was talking about earlier, where we introduce certain formulas in quant. How do you calculate covariance, your correlation coefficient, et cetera. But then while we introduce it in quant, we actually apply it here in portfolio management. So these were the most missed questions. You got to love it. So we got you covered. So you're going to learn a little bit, but more I want to illustrate like how we use the topic, to review the concept. Okay. So really that's what it is, using that question to review the concept. So let's jump in. This was that corporate governance. So they want to know here, hey, a lack of corporate governance mechanisms to manage creditor conflicts. Okay. So the first thing is with creditor conflicts, the big deal is with a corporation, as we all know, there are agency issues. The people that run that entity day to day, are not the owners. I mean, they could be partial owners, but, you have the shareholders who elect the board. The board obviously then has to elect the day-to-day officers, the managers of the company. So there's conflicts. Creditors are concerned because generally creditors and preferred stockholders don't have voting rights. So when you lend that money, you got to have a lot of debt covenants that contract up front to protect your interests. Because if they issue excessive debt later on, what's that going to do to the value of your debt? Well, as the debt to equity goes up, that credit rating is likely to go down. Cost of debt's going to go up for this company, and your debt, paying that old low rate when there wasn't as much debt, well, that's not going to be worth a lot now because newly issued debt for this company, is going to be paying a higher rate because the risk has changed. Okay, so creditors are very worried, rightfully so. They don't want you taking excess cash, or surplus cash and paying excessive dividends or repurchasing a lot of your own stock. Why is that? Because that cash flow they want set aside to do what? Service the debt as it becomes due. So as you take that cash and you pay dividends or you buy back stock, while there's no change to the debt, when you do your debt to equity ratio, your equity is going down. That means your debt to equity is going up again, which could negatively affect the value of the debt. So, weak management of creditors' interest, that's going to affect the company's financial position. It can hinder their ability to pay their debt as it becomes due, which obviously is going to negatively affect the value of that debt, their credit rating, et cetera. So your corporate governance, those arrangements are looking to manage those creditor conflicts, okay? So we want to restrict certain corporate actions that can hinder the company's ability to repay their debt, expose them to greater risk of default. All right, so a lot of those ratios we look at, et cetera, we're looking at setting aside that cash to service the debt. We want to make sure they're not issuing excessive debt, paying excessive dividends, repurchasing too much stock, et cetera. So when you look at creditor conflicts from here on in, you're thinking, hey, that's all about financial risk. Okay, so creditor conflicts, it's a word association game. You're thinking all about, hey, that's that financial risk. Can they pay that debt as it becomes due? Now, the beauty, what I was mentioning earlier of UWorld, and the reason I want to show you this is, if you look at the detailed explanatory answer, as I mentioned, sometimes, it's, might explain why the right answer is right. Look at what we do here. Not only do we explain why the right answer is right here. So when you see creditor conflicts, you think, hey, that's all about the financial risk, et cetera. But what are the benefits of strong corporate governance? Why is that so important? Folks, when you have strong corporate governance, what's that likely to do to your cost of capital? Well, it's likely to reduce your cost of capital because cost of capital is the compensation that the investors want to compensate them for the risk assumed. So if they feel more secure, then logically they're assuming less risk. They would demand a lower rate of return. So that reduces the company's cost of capital, which is going to make it a lot easier to find investments where the return on the invested capital is lower than the cost. The lower the cost, the lower your hurdle, right? So you're likely to have more positive NPV projects, IRR, et cetera. So you need to know, hey, what's the difference between that financial risk versus regulatory risk versus operational risk? We want to make sure. I don't know if they're going to ask you about financial risk exam day. They might. All right. So that financial risk, can they pay their debt as it becomes due? The creditors are very worried about, obviously, the value of their debt. And once they lend the money, that's it. They don't have any voting rights after that. So, we'll talk greater detail about that, obviously, in the course. Debt covenants, certain things affirmative the company has to do, safeguard those assets. And then certain things, negative restrictions that they cannot do, which we've mentioned. Okay. Regulatory risk is all about what? Making sure you're complying with laws, meet your disclosure requirements, transparency, fulfill your obligations. Okay. So regulatory risk, you think, what's the big deal? Big deal. Multinational operation doing business all around the world. Boy, oh boy, oh boy, man, you got to be an expert now in every country's laws, rules, and regulations. All right. Otherwise, you're going to have big problems. And sometimes, even though you're doing business in the country of ZANU, if you're incorporated in the United States, well, guess what? If the country of ZANU allows you to trade on material non-public information, the U.S. does not, and the CFA Institute certainly does not. If the country of ZANU says it's okay to bribe officials so that you can get your permit to start building whatever it is you're constructing in that country, well, that's nice in the country of ZANU, but the Foreign Corrupt Practices Act in the United States is not, man. Even if that country, and that's where you're doing business, you're incorporated here, we're not having you pay bribes, okay? So important. Operational risk, we'll talk about in accounting, internal controls. You can't completely eliminate, but we're looking to reduce the probability that those financial statements are misleading, right? That there are material errors or omissions of material facts. The big issue with audit, when I did it back in the day, what makes it material? What would a reasonable investor like to know? Would it affect your decision-making process? So that materiality threshold. But internal controls, look, the auditors are not responsible for the internal controls. They have to express an opinion about the company's internal controls, but that's up to management. All right. So that's that corporate governance again. Is there an audit committee? Are they independent, etc.? So again, I love the way UWorld takes the time to say, hey, at the end of the day, why is corporate governance important? What is A all about, but what are the wrong answers all about as well, right? So that's pretty cool. So you learn from every question. Slow and steady wins the race. So even if you got it correct, there were things you could have learned from that explanation, I bet. All right, fixed income, one of my favorite topics, and I'm going to insert a slide here because I'm going to be doing lots of extra stuff here, but let me get back. All right, so this question talks about a non-parallel shift. The first thing you're thinking is, what in the hell is a non-parallel shift? We got to know the difference. All right, so you're thinking, what's a parallel shift? Well, normally the yield curve is positively sloped. If we look at our rates relative to term to maturity, normal, we would expect the yield curve to be positively sloped. If you want to tie up my money for a longer period of time, we're expecting, hey, short-term rates probably going to be lower than long-term. Illiquidity premium. You want to keep my money for 3 years instead of 1 year? Hey, you know what? It's a lot easier for me to forecast you paying me back in a year, but 3 years from now, what the hell is going to happen in 3 years? I don't know. You got to change the 9-volt battery in your crystal ball, So nonetheless, general rule, the yield curve positively sloped, but not always. A parallel shift just means all rates change by the same amount and in the same direction. So whether it's short term, went up 5 basis points, medium term, went up 5 basis points, long term, went up 5 basis points. When you have a parallel shift, and you have a bond portfolio, you can use what's called your weighted average duration to find the percentage change in the value of that portfolio. Okay, so you can use your weighted average duration to find the percentage change in value of a bond portfolio, where maybe you've invested some in the short term, some in the medium term, some in the long term. Okay, now a non-parallel shift, you're thinking, well, the change in the short term, medium term, and long term are not all the same. So let's say we start off with positively sloped yield curve. Here's your short term, here's your medium term, here's your long term. We might have what's called a twist in rates. They love that. So a twist in rates. So short-term rates, let's say, went up. Long-term rates, though, let's say went down. Okay. Medium term, no change at all, as a matter of fact. So that's one example. We could have a change in the slope. Okay, so maybe this was our original yield curve. Let me make it a little bit flatter. Maybe our yield curve was relatively flat and it gets steeper. So all rates are going up, but not by the same amount. That's also non-parallel. We have a change in slope, right? But what's the deal? I love the non-parallel shifts. First of all, immediately you think with a non-parallel shift, you've got to use KRD. Yeah, you know me, key rate duration. So word association game. What in the hell is key rate duration? We'll talk about that in a second. But you see a non-parallel shift in the yield curve. One of the things we like to do is when you have a bond portfolio, I always, obviously, if I can forecast this change in rates, and I'm thinking, well, if short-term rates are going to go up, Well, the price of those bonds are going to go down. So I want to sell the short term. And if the long-term rates are going to go down, the price of those bonds are going to go up. So you may want to sell the short term and buy the long term. And then we're going to talk about the term duration itself. Sensitivity to changes in rates. When the news is bad, I don't want to be sensitive to bad news. No. I want to be sensitive to good news. Okay, so here the news is bad all across the yield curve. Short term, medium term, long term. Rates are up, prices are down. You want to reduce your duration when the news is bad. Increase your duration, as you'll see, when the news is good. All right, so non-parallel shift, you think key rate duration. Now, puttable bond, we're going to talk about a puttable bond. When you see puttable bond, you're going to think cap on value. Yeah, it's cap on value. You're going to think extra positive convexity. That's how you're going to tell a straight bond from a puttable bond, by that extra positive convexity. You're also going to think whether it's callable or puttable, your duration goes down. Why? Because you're going to get your money back sooner. And when it's sooner, you get your money back at your option when rates have gone up, so you can reinvest at today's higher rates, okay? So duration goes down. All right, so a lot you can learn, but this is what I'm saying. Like, we're not going to just answer this question. Like, the goal is to use the question to review the rule in its entirety. So when you see modified duration, you're going to be thinking, I'm using that when it's option free. This one is not option free. Obviously, we have a put option. Okay, whenever you see effective duration, you're going to think, hey, those bonds have embedded options. I got to use effective duration, the E in effective, the E in embedded options. Because whether it's callable or puttable, duration's going to go down. You're going to get your money back sooner. Now, when it's callable, you're going to be thinking negative convexity. Okay, we'll get there in a second. You'll think cap on value. All right. But with call options, the good news is you get your money back sooner. The bad news is, why did the company call back that debt? Because rates went down. They want to refinance at today's lower rate. So they give you back your money. Now you got to loan it out, but at a lower rate, assuming the same level of risk is now paying a lower rate. Okay. When it's a puttable bond, you're going to exercise the option if rates go up, because I don't want to be stuck with this old crappy bond paying that lower rate when a newly issued bond with the same risk is paying a higher rate. So you'll put the bond back on the issuer, get your money back. Either way, duration goes down. Okay, so this is, and then look at the beauty again. Oh, there's like blank slide. Just look at the beauty of the detailed explanatory answer. Okay, going through first the different types of bonds. Okay, when you see Macaulay duration, again, duration, you could look at it in one of two ways. Time, how long is it going to take me to recoup my investment? You could also look at it in terms of sensitivity to changes in interest rates. Okay, so different ways of looking at duration. But when you see Macaulay duration from here on in, I want you to think about time. Okay, modified duration. Now we've got a change in the bond's yield to maturity, the market rate, compensation for all risk assumed. Whereas effective duration, we're looking at sensitivity because the benchmark yield has changed. Okay, and we'll talk about the yield to maturity. Well, what's the benchmark paying? And maybe that's the risk-free. But a corporate issuer is certainly not risk-free. So if I can invest risk-free for 5 years at X, I want X plus if I'm buying a corporate bond that's going to expose me to risk. Okay. So again, money, we can look at our sensitivity and say, hey, what's the price value of a basis point, et cetera, et cetera. Okay, so really good. Now, again, I want to use the question to review the rule in its entirety, because fixed income obviously is a topic that gives people a lot of problems, okay? So in terms of duration, again, are we looking at in terms of time? You immediately think MAC. And from here on in, you're actually going to think Mackey, Macaulay duration, but Mackey in particular, okay? Another way, sensitivity to changes in interest rates. All right, so one of the things we're thinking is, hey, how do we quantify duration? Well, if rates go down, the price is going to go up. If rates go up, if rates go down, minus P low, rates go up. So look at what's in your numerator, the high price minus the low price. Okay, look, that's the sensitivity to that changes in interest rates. What's the spread when rates change? What's it going to do? High side, low side. Then you're going to divide that by 2 times today's price times your change in rates expressed as a basis point. Okay, 1 basis point or 10 basis points or 50 basis points, but you express it as a decimal. That's how we quantify duration. But really, it's dependent upon that numerator, right? That spread in the numerator. Now, one of the things they always ask is, what's going to give you high duration? What's going to make you really sensitive to changes in interest rates? High duration, it's going to take you a long time to get your money back. You're very sensitive to those change in rates. So the longer the term, the more sensitive you're going to be. Think of time, recoup my initial investment. Well, if it's a low coupon, you're trying to, what's my payback period? Well, are you paying me coupons so I could start chipping away at what I paid for that bond? If you have a low coupon, it's going to take you longer to recoup that cost. And then lastly, when you paid a premium, and why would you pay a premium? When is the bond going to trade? You don't memorize, you think. Why is this bond trading at a premium? Because the market rate is less than the coupon rate. All right, when that market rate is less than the coupon rate, that bond trades at a premium. You're paying more for that bond. And by the way, is a premium a gain or loss? I don't know. Where am I on the exam? Because if you're the issuer in accounting or corporate finance, that premium is a gain. Make your interest expense actually less than the coupon paid. Your coupon only reflects your actual cost of borrowing when you sell the bond at par value. If you sell it above or below, then that coupon's misleading. That's not your cost of borrowing. It's the yield to maturity, that market rate. Okay, so while from the perspective of the issuer, they sell $1,000 bond, collect $1,050. That's beautiful, premium, gain for them, but it's a deferred gain. We call it an unamortized premium that they will recognize over the life of the bond by making the interest expense less than the coupon paid, as you will see when we get to accounting. But from the investor's side in fixed income, you buy a bond at premium, built-in loss. Yeah, that's right. You're lending $1,050, you're only getting back $1,000. Now your interest income, your actual income is less than the coupon received. Your coupon, that's not your income because you didn't pay par. You paid more than par. So whether a premium is a gain or loss depends upon where you are on the exam, okay? Now, your initial yield to maturity, when you sell that bond, what's your probability? First of all, of earning that initial yield to maturity? Well, you'd have to hold it to maturity. All payments are made on time, but most importantly, every single coupon you reinvest at that initial yield to maturity. And what's the probability of that? Very low. Okay, chances are you're going to reinvest every coupon, especially if it's got a long term to maturity. You're going to reinvest those coupons probably at a very different rate than that initial yield to maturity. So then how in the hell do you calculate the true yield on this bond? Well, tell me, did you hold it to maturity or did you sell it early? If you held it to maturity, then your terminal value will be your par value. If you did not hold it to maturity, then we're going to have to calculate your selling price. And your selling price will be dependent upon what interest rates were at the time you sold the bond. Plus, what's another way you make money on bonds? Not only the terminal value, but what else? Future value of your coupons. Okay, what did you reinvest those coupons at? And then you divide that by your costs. Subtract 1, there's your true yield. Okay, so your selling price minus your cost, or your par minus your cost. All right, there's your capital gain, and then your income, the coupons over the term of that bond. That's your true yield. So now the question becomes, why do we need this thing called Macaulay duration? And what in the hell is this thing called Mackey? Duration gap. Is it positive or is it negative? Duration minus the investor's time horizon. Okay, duration comes out to be 10. Let's say the investor, though, has a relative horizon of 3. 10 minus 3, positive 7. Forget the positive. All right, when you have positive duration gap, where's your real risk? Well, you're a relatively short-term investor. What's your risk? What is your risk? What are we emphasizing? The selling price. Okay, I don't care about the future value of the coupons. I'm not holding it all that long. So price risk dominates. Price risk is what's dominating for the short-term investor. So what are they actually hoping? That rates go down when they sell it so they could sell it at a gain, because that's going to dominate the two ways you make money on that bond. Okay, the difference between your purchase price and your selling price or the future value of the coupons. Now check this out, right? Your Macaulay duration is 10, but let's say the investor's time horizon is 15 years. Okay, -5, just focus in on the negative. Look at this, the investor's time horizon, they're a long-term investor. Oops, sorry about that. They're a long-term investor. Now what dominates risk? Reinvestment risk. What's going to determine the value, the yield for them? They're all about the future value of the coupon. So it's counterintuitive. Long-term investors, man, they actually want rates. Whoops. They want rates to go up. Sorry about that. They want rates to go up because what's going to dominate their yield? The future value of that coupon. Okay, so that's why you learn about Macaulay duration, etc. Now, let me just do one more thing here. Want to make sure we really understand. Sorry about that. Want to insert another blank slide, so bear with me. There we go. Okay, so price yield relationship. This duration, it looks like there's a linear relationship, right? Here's the price of the bond. Here are rates. Here are rates today. Rates go low. We know when rates go down, price goes up. Here, rates go high. Okay, when rates go up, price is going to come down. And it looks like we have the exact same sensitivity. Whether rates go down or up, it looks like we have the exact same sensitivity. Not true. That's duration. But the actual price yield relationship is curved. If you could draw the letter C, you understand convexity. You see, when you have a relatively small term in rates, small change in rates, less than 10 basis points, duration alone would be a pretty good estimate of your percentage change in price, but not when you've got a relatively large change in rates, because when rates go down, price goes up faster than duration alone would project. And when rates go up, price comes down slower than duration alone would project. Straight bonds and puttable bonds only have positive convexity. Callable bonds will have positive convexity when rates are up. The only time you'll see negative convexity, and we'll learn about that in another class where we do the bond options, when it's a callable bond and rates are going down and the market's anticipating the issuer to call back that expensive debt to refinance at today's lower rates. Otherwise, bonds are going to have positive convexity, okay? So the curvature of the price yield relationship, that's the convexity, the divergence from the slope, okay? So just if you could draw it out and you could draw the letter C, you now understand convexity. So the goal with duration is to figure out, okay, what's the percentage change in the price of this bond or the value of my portfolio? Okay, so whether it's an individual bond or it's a portfolio of bonds, when it's a portfolio of bonds, if it's a parallel shift, we could use weighted average duration. How do you get weighted average duration? Tell me the percentage I have invested in the short term times its duration. Tell me the percentage I have invested in the medium term times its duration. Tell me the percent I have invested in the long term times its duration. Get me the weighted average duration for this bond portfolio. If it's an individual bond, then just tell me the duration of that bond. Okay? So always put a minus sign in front of that duration, which you're going to express as a percentage. Because why a negative sign? Because there's an inverse relationship between the change in rates as price, as we've seen, negative slope. All right, then you're going to multiply that by your plus or minus change in rates. You got to put in that sign. This we're going to express in basis points as a decimal. This is called the first order effect. You want to project, hey, what's the percentage change, the sensitivity? Go ahead and just do that, so long as it's a small change in rates. But when it's a large change in rates, small is generally defined as less than 10 basis points. You start getting above 10 basis points, now you got to look at the second order effect, your convexity. We take 1/2 of your convexity, which at level 1 they'll probably give you. And remember, convexity could be positive, usually, or negative. The only time we're going to have negative convexity is when it's what? Callable, and rates are going down. All right, so negative convexity times your change in rates as a basis point squared. That's called your second order effect. All right, so if you've got positive convexity, duration's going to overstate, okay, what's going to happen, or maybe understate, depending upon what's going on. So if rates go, let's say, down, price goes up, well, with that positive convexity, the price is going to be a little bit higher than where duration has it if rates go down. Now, conversely, if rates go up, duration's going to overstate the sensitivity. Say price is going to be down there. No, actually, price is going to come down, but slower than duration alone would project. All right, so that's our first and second order effect, but that's the big picture with a lot of those concepts. And then we'll talk about callable, puttable, all that good stuff. Key rate duration at level 1, you got to know when to use it. Okay, so key rate duration is very important. More important, I should say, at level 2, where we actually apply it, where the change in the short term, change in the medium term, change in the long term are not all the same. This is how you would actually calculate key rate duration for the short term, for the medium term, for the long term. And then you would take the change in rates for the short term times the key rate duration for the short term, take the change in rates for the medium term, which could be different from the short term. Okay, multiply the key rate duration for the medium term with a minus sign in front of it, always. And then the change in rates for the long term could be different from what it was for the medium term or the short term. Make sure you put a minus sign in front of the key rate duration for the long term. And that's how you'll find the percentage change in the value of a portfolio of bonds where you're invested across different yields to maturity, different terms to maturity. Excuse me. And that's how we'll get our sensitivity to those changes in rates when it's a non-parallel shift. But the math we do at level 2. Just remember at level 1, you see key rate duration. You're thinking we use that with a non-parallel shift. Woo, baby. I feel like I'm giving birth to a fixed income analyst. All right, let's go. Let's try our next one in our most missed questions. All right, this one was, let's see what we got. In comparison with holding a single security, constructing a portfolio of multiple asset classes. Why do you want to do that? Well, we want to diversify. We want to assume no risk for which we are not rewarded. Now, we introduce in quant, but really in portfolio management, we look a lot at the Sharpe ratio. Okay, the expected return on this portfolio over the risk-free rate divided by the standard deviation for that portfolio. Okay, this is your risk premium divided by the standard deviation for that portfolio. Sharpe, higher the better. Okay, I want to get a return on that portfolio well above that risk premium. Okay, but I got to make sure that incremental return is sufficient given my incremental risk. And you never want to assume any risk for which you're not rewarded. So all things being equal, what do we want to do with the standard deviation for that portfolio? We want to minimize it. You want to assume no risk for which you're not rewarded. Now, I don't mind assuming risk if my client is willing and able to assume that risk and they're properly rewarded for that incremental risk, right? The incremental premium has got to outweigh the incremental cost of that additional risk. Okay, so we want to diversify. Multiple asset classes. Your traditional asset classes, obviously, your debt, your equity. Then we start adding in your alternative investments, your real estate, etc. All right, hedge funds, private equity, venture capital, whatever it may be. But the goal is to diversify. Now, how do we measure, that ability to reduce risk? Covariance gives us the relationship between the assets, but not the strength. Do these assets tend to go up together, positive covariance? Do they tend to go in opposite directions, negative covariance? But when you want the strength of that relationship between those particular individual assets or asset classes, that's where we want our correlation coefficient. That measures the strength. So yes, we still look at the covariance, positive or negative, but then that's relative to the standard deviation of the first asset, the standard deviation of the second. Your correlation coefficient is going to have a range between -1 and +1. +1, you've got no diversification benefit whatsoever. All right. So if you bought that additional asset or asset class because you told your client that, hey, this is going to help diversify away risk, you know what? You just committed fraud. If you knew or should have known that that was not the case. Like I have friends all the time say, Pete, I'm invested in 40 different mutual funds. I'm diversified. Don't worry about it. As you could tell, my friends are from Mississippi. That's how they talk. So I'm like, let me just see your 401k where you're invested. Yeah, they're in a bunch of different funds, but the correlation is basically +1. They're all going up together and they all go down together. You're not diversified at all. I hate to tell you, even though you invested in 50 different funds, man, you wasted your money. You could just put it all in one fund because they're all going up and down together. You wasted your time. Okay, you want to reduce risk? Find me assets that are uncorrelated. You want to maximize risk reduction? Get closer and closer to a correlation of -1. You want to completely lock in a rate of return? You want to hedge? All right, then I want a perfect -1. Okay, one goes up, the other one's going to go down. Now, the downside of that is they can't go up together, obviously. So there's a cap on your upside potential. Okay, but that's going to be your maximum risk reduction. So low was the most common wrong answer choice. Okay, so I think 50% of the people selected low. We're looking for negative correlation, folks, negative. All right, that's where the value is. If you're looking to maximize risk reduction, okay, so to most effectively reduce risk, if that's the goal, to most effectively reduce risk, then we're looking for a negative correlation, not a low correlation, okay? Now, how do you calculate the variance of a 2-asset portfolio so you understand this input into the calculation? Well, you take the weight of the first asset, square it, times its variance, plus the weight of the second asset, square it, times its variance, plus 2 times the weight of the first times the weight of the second times either covariance or correlation coefficient times standard deviation of the first, standard deviation of the second. All right. So if the right-hand side of this equation is negative, the left-hand side is always going to be positive. That negative is going to offset this positive to reduce the variance and thus reduce the standard deviation of that portfolio. Okay. So what I normally like to do, and I think I'm doing okay on time here, I just want to illustrate, like, because I think it's so important. Yeah, you know, you see it, but let's just apply it. So what I like to do when I'm in class, just to give you a feel, is like even with a theory question like that, let's say I'm investing in 2 assets, X and Y. X has a standard deviation of 15%. Y has a standard deviation of, let's say, 12%. Okay, so let's say it's a 50-50 weighted portfolio, 50-50 weight. So the weighting of X and Y, I got 50% of my money in asset class X, 50% in asset class Y. And it's a 50-50 weight. What's my weighted average standard deviation? Well, 7.5 plus the 6, 12.5. Okay, ignoring the correlation coefficient, that would be the standard deviation of this portfolio if you ignored the correlation between those assets, okay? If you ignored it. Now, if your correlation coefficient is not ignored, but it's +1 or close to it, then the standard deviation of that portfolio is going to be really close to that weighted average standard deviation of 12.5. You're not going to have diversified away much risk. But as your correlation coefficient gets closer and closer to 0, now we know the standard deviation for that portfolio is going to be below that benchmark of 12.5. Now, as that correlation coefficient goes down towards -1 or close to it, now the standard deviation for that portfolio is going to get closer and closer to 0. Now, depending upon the weighting and the individual standard deviations, I'm not saying it's going to be 0, but now you're getting close to, okay, getting away from any risk. All right. Perfect hedge. Okay. So, you know, if you prove this mathematically, you ready? Let's just say our correlation coefficient, for example, is in fact 0. What would the standard deviation for this portfolio be? Well, the variance, 0.50 squared, times the variance of the first, 15 squared, plus the weight of the second squared, times variance of the second, plus 2 times the weight of the first, times the weight of the second, times your correlation coefficient, 0, times the standard deviation of the first, times standard deviation of the second. Well, anything times 0 is 0. Now, this piece of the puzzle is 56.25. This piece is 36. Square root, add that together, of 92.25, 9.6. Okay, so now we're well below, and that should be 13.5. Geez, I can't even freaking add. 7 plus 6. Now see, I'm building your confidence. Yeah, you're like, how'd this dumbass pass? If I passed each level on the first attempt, you know, and I was in the top 10%. I hate to tell you that. I mean, you should be getting a perfect ass score. All right, so obviously 9.6 is less than 13.5. Okay, less than 13.5. So we have significant risk reduction. Now, what if you make R, instead of being 0, what if you make it -1? Then rather than adding nothing, so let me get rid of that, we still got these two adding up to 92.25. Now the right-hand side of the equation, if we make R -1 instead, then the right-hand side, -90, is offsetting the left-hand side, 92.25. So now the square root of 2.25, 92.25 minus the 90, if R is -1, the right-hand side is 90. Now you're looking at a standard deviation for this portfolio approaching 0. It's not 0, 1.5, but less than the 13.5 benchmark. Okay, so 7 plus 6, make a note, that would be 14. All right, so again, look at our beautiful detailed explanatory answer for you again. All right, so the goal again is to make sure not only can you answer this question, understand why the right answer is right, the wrong answers are wrong, but what's the big issue that's going to be focused in on? And then look, then we take R, whatever your correlation coefficient, we square it. We want to remind you that word coefficient pops up a lot, right? So that's something called your coefficient of determination, the percentage change in the dependent variable explained. Don't use the word caused, explained by the percentage change in your independent variable. Okay, so that's called your coefficient of determination. So you got to keep all this stuff straight. You got your correlation coefficient, then you got your coefficient of determination. Okay, then you got your regression coefficient. So maybe we're looking at our slope. That's the change in the dependent variable divided by the change in the independent variable. Okay, so the word coefficient pops up in a lot of places. We got to keep it straight. Correlation coefficient is different than your coefficient of determination, which is not the same as your regression coefficient, et cetera, et cetera. All right, so this is what we do in class, remind you of the differences and where all the dots connect. Okay, fourth most missed question, and how are we doing on time? We're doing wonderful on time. We are on time, baby. All right, what's this one? They tell us, let's see. So they say, and corporate credit analysis. All right, we got corporate credit analysis. Leverage ratios focus on the balance sheet and are most likely used to evaluate a company's what? Let me just say, a lot of people, I believe, yeah, the most common wrong answer choice was choice A. Now, you're thinking leverage, wait a second. I mean, it was emphasized to me when I learned all about the DuPont model. Leverage is an amplifier in the DuPont model, right? Your return on asset combined with your degree of financial leverage, well, there's your return on your equity. Leverage amplifies risk assumed. It amplifies risk assumed and your potential return on equity. And you're thinking, well, how do I calculate that degree of financial leverage for the DuPont model? It's either your asset divided by your equity, which is basically A, or 1 plus your debt divided by your equity. Okay, same result, different format, but it amplifies risk assumed and your potential return. The problem is, folks, we're not doing the DuPont model. Where are we? Credit analysis, just like is a premium, a gain, or a loss? I don't know. You got to tell me, where am I on the exam? Because if I'm looking at that premium or discount from the perspective of the issuer, accounting or corporate finance, I can answer the question now. Oh, if I issued it at a discount, well, that's a loss to the issuer. Bad news, my interest expense will be greater than the coupon paid. But if they're asking me in fixed income about that discount, zero-sum game, their loss is my gain. My interest income is now greater than the coupon received. How the hell could that? How could you have income greater than the coupon received? Because I didn't pay par value. I paid less than par value. So when you look at the price paid, which was a discount, yeah, that market rate, that additional yield to maturity was greater than the coupon. My interest income is greater than the coupon. All right, so we're not in the DuPont model, though, which is where we obviously, a lot of this is used leverage. We're in credit analysis, folks. So in credit analysis, what are we looking at? Your ability to pay your debt, okay? And what are we going to use to pay that debt? Earnings, cash flow capacity, okay? Now, earnings is nice, but that's accrual base. That's good, but that's not cash. There's nothing better than that you're going to learn in the accounting section. Why is accrual basis net income different from your cash flow from operations? And can you believe this net income number? Is that high quality? Well, the closer these numbers are to each other, the more I believe what's in that net income number, because that's skewed by management bias. Methods of accounting, estimates. Cash flow, it's cash in, cash out. Unless somebody's committing some serious fraud, it's subject to much less management manipulation. Okay, unless they're going to commit outright fraud. All right. So nonetheless, in this reading, credit analysis, when we talk about leverage, we're talking about, about debt, but we're looking at our ability. It's all about credit rating. Can you pay the debt as it becomes due? Okay, so the amount of debt financing relative to what are you going to have available to service the debt? The goal is to service that debt when it becomes due. All right, got to pay that interest as it becomes due. If it's amortizing debt, every payment is bigger because now you got to pay both principal and interest in every payment. If there's a balloon payment on the back end, if it's a bullet, all like a typical corporate bond, all the principal's repaid at maturity. I know you're not going to have any problem paying the coupon for the next 10, 15, 20, 30 years, But man, you're going to have money set aside. You got a sinking fund. Are you saving to pay down that debt when it becomes due, right? So these are the things we're looking at. So again, beautiful, detailed, explanatory. Oh, and by the way, you could see more than half the people chose A, okay? Because they looked at leverage, but where am I on the exam? If we were in equity, okay, if we're in corporate finance, if in your financial statement analysis, that's where we are applying the DuPont model. Okay, that's when A would have been the right answer in those readings, but not the credit analysis reading. Okay, so A is just not appropriate given this, section of the exam. All righty, so there's our beautiful, detailed explanatory answer again. So credit analysis ratios. You don't have to memorize, but you got to understand the key thing, the key takeaway from this question is leverage here is all about ability to repay that debt as it becomes due. All right, so what kind of earnings do we have available, okay, to pay that debt? Okay, coverage ratios, any type of coverage ratio, it's what you have available in the numerator to pay what's coming due in the denominator. There are many types of interest coverage ratios. EBITDA could be in your numerator. The bigger the spread, current ratio, what do you have in the numerator to pay what's in the denominator? The bigger the spread, the lower the risk. Okay, with any type of coverage ratio, what you have in the numerator to cover that denominator. Okay, profitability, cash flow measures, etc. All right, so now let's see what we got next. The fifth most incorrect question, number 5. Let's stay alive. Oh, net operating cycle. Love this. You're going to see this. FSA and in corporate finance. So buy one, get one free. So as soon as I see net operating cycle, I'm thinking that's my number of days to sell plus my number of days to collect. That gives you what's called your operating cycle. Look, this is all about the business's ability to generate cash from their core business. I'm not impressed if McDonald's, all of a sudden comes up with $1 billion, $2 billion, $10 billion, whatever the number is, because they sold real estate. Yeah, they got a lot of cash and they probably sold it at a huge gain, which is driving up net income, which is going to drive up their earnings per share. A lot of people are going to be looking to buy that stock. What if they sell off all their real estate? How the hell are they going to sell hamburgers and French fries in the future if they close down all their stores and sell off the real estate, right? That's not operating. That's non-operating. You can't reproduce that, right? So the operating cycle is really looking at the cash we could generate, but most importantly from our core business. All right, so number of days to sell our primary product or service, our inventory. How long does it then take me to collect? You know what this is all about right here? Your company's credit policy. The best credit policy is the one that's going to minimize the operating cycle. We want that less than or equal to the standard. You see, you could have a really strict credit policy, or you could have a really lax credit policy. There's good news and bad news. When you have a really strict credit policy, you'll have no problem collecting. But good luck finding someone who's credit worthy that you can sell to. So you'll collect fast. You're just not going to have a lot to collect. There's not a lot of people that have a credit rating, 830. Good luck. Now, you can have a really lax credit policy. Every commercial you see on TV for a used car, no credit, no problem. Oh, yeah. No problem to sell it, but you're going to have a big problem collecting. It's good for the repo man because you're lending money to anybody who walks in the door. Your number of days to sell is going to be really low, but it's going to take you a long time to collect if you collect it all, right? So the best operating cycle, we want the best of the two. We want to balance. It's the policy that minimizes the operating cycle. Then we subtract the number of days to repay the vendor, okay? You want this number to be relatively low. You want to stretch this out, folks. You want that to be relatively high. What do I mean by relatively high? If you're giving 30 days to pay, don't pay in 2. Don't pay in 5. Pay on the last day. Why? Because I want my money invested earning as much for me, not for somebody else. This bill's not due for 30 days. Next 30 days, it's going to be working for me, earning interest or dividends or something. This is like the government when people get back huge tax refunds. And so what are you doing? You're giving the government an interest-free loan. Had you had this money all year that they're only giving you back your own money, it's not theirs. They're giving you back your own money. It's an interest-free loan to the government. You want to give an interest-free loan? I got no problem with that, so long as I'm the borrower. Outside of that, please don't lend for nothing. All right, so nonetheless, number of days to repay the vendor. Stretch it out. They love this one. Stretch it out. If you're given 30, pay 30. Now, the reason many of you went into finance and didn't go into accounting because you took that first accounting class and you were ready to vomit. And you're like, oh, 210 net 30. What the hell is that? Oh, well, now it's a different story. You offer me a 2% discount if I pay in 10 days. Now, the opportunity cost of not taking advantage of that discount is way too high. You got to take advantage of it. Now I can see you paying in 10 days, but don't pay in 8. Pay in 10. Okay, and then you get your 2% discount. Otherwise, you got to pay in 30 days. Okay, so stretch it out unless they're offering you a discount. Unless they're offering you a discount. If there's no discount, stretch it out. Now, don't be late. I don't want fines and penalties. I don't want to screw up the credit rating. So this is our quote-unquote net operating cycle, also known as our cash conversion cycle. Extremely important in corporate finance, your ability to raise capital. I don't want to have to issue more debt. Okay, even though I get a tax break for the interest expense, which is good, lowering the cost of the debt, and even though debt is cheaper than equity because they get their money back first in the event of a Chapter 7 liquidation, okay, so it's relatively cheap, but eventually it ain't going to be so cheap because the higher your debt to equity, all of a sudden your risk that you're exposing your creditors is going up, credit rating down, cost of debt's eventually going to go up. So I don't want to issue too much debt. Well, then issue equity, add partners. Well, adding partners is a lot more expensive because dividends are not tax deductible. And they demand a higher rate of return because they're last in line, common stockholders, in the event of a bankruptcy. So they're going to demand more than the debtors, the creditors, and also the common stock. Newly issued common stock, good luck. You got an accountant with their hand in your pocket. You're going to have a lawyer with a hand in your pocket. You're going to have an investment banker with your hand. Yeah, the cost of capital is really high for newly issued because of your flotation costs. So a great way to generate cash where you're not adding more partners, which, by the way, will dilute your earnings per share, nor are you adding too much debt that'll ruin your credit rating and raise your cost of capital for everything. No, I'm going to generate my own internally generated cash that keeps your cost of capital down, okay? So you want your cash conversion cycle to be less than or equal to the standard. So an increase, all right, so the net operating cycle. So I'm thinking it's either because my number of days to sell went up and or my number of days to collect went up, either one making my operating cycle go up. So that's an and or my number of days to pay went down. You're subtracting a smaller number. That'll make your net operating cycle go up. If that goes down, you're subtracting a smaller number, your net operating cycle is going to go up. So if you increase your inventory turnover, oh no, so now they're digging into the details. We love it. Challenge me. Don't make this exam too easy. You're going to upset me. So how do we get your number of days to sell? Tell me cost of goods sold. Divide that by your average inventory. Okay, we're increasing our inventory turnover. You ready? 365 divided by your inventory turnover. There's your number of days to sell. If you increase your inventory turnover, okay, your cost of goods sold is higher, your average inventory is lower, okay, you're simply turning it over, which is good. You want asset turnover, a measure of efficiency. You want to turn over your assets quickly, but you don't want to turn over your liabilities too quickly. But nonetheless, your number of days to sell would go down. That would make your operating cycle go down, which would make your net operating cycle go down. So it can't be that. Okay. So what else do we got? Delaying payment to suppliers. My number of days to pay. Okay. Delaying collection. How do we get that, by the way? That's either your purchases, if you've got that, or your cost of goods sold divided by your average accounts payable, which is called your accounts payable turnover. Divide that into 365. There's your number of days to pay. So they said in choice B, delaying payment. So folks, if your number of days to pay goes up, your operating cycle minus your number of days to pay. If that goes up, you're stretching it out. Your net operating cycle goes down. So B was a common wrong answer choice. Okay. B, I believe, was the most common wrong answer choice. And let's confirm that. Yes, B was the most common wrong. Nobody chose A, but a lot of people got fooled by B. Okay. Your number of days to pay. Folks, as your number of days to pay goes up, the higher the number you subtract from your operating cycle, the lower your net operating. Remember, you want to stretch it out. It's counterintuitive. It's good. Stretch it out is good unless you're given an incentive to pay quickly. Stretch it out. Take full advantage of interest-free grace periods. Okay, how do we get our net number of days to collect, by the way? Since we're reviewing our formulas, our number of days to collect. Your net sales, you never use gross sales in any ratio. Net sales, your sales minus your returns and discounts, divided by your average accounts receivable. That gets you accounts receivable turnover. Divide that into 365. There's your number of days to collect. Remember, we want to collect quickly, relatively quickly. So we want to make sure people we're selling to are credit worthy. But you don't want to have too strict of a credit policy because then that could delay your sales and they may go to competitors, right? So we want a relatively high accounts receivable turnover. We want asset turnover to be greater than or equal to the standard, but not a liability turnover. Liability turnover, you want to stretch it out. Don't turn it over too quickly. Don't pay it too quickly. No fines, no penalties. Don't be late, but don't pay early unless you're rewarded for paying early. If they give you 30, take the full 30, right? Okay, so our correct answer here is it can't be A. Okay, increasing inventory turnover. If you increase your inventory turnover, your number of days to sell goes down, operating cycle down, net operating cycle. Delay collecting credit accounts. So if it takes you longer to collect, that'll make your operating cycle higher, which will make your net operating cycle higher. So C was on the money. So look, this is what we do in the class. You know what? We have these Saturday classes, or actually that we're recording them. We're calling them master classes where we apply the logic that you've learned through the videos, but we practice the end of chapter questions in the actual CFA Institute reading, you know, and or we practice questions, you know, in the software that we see a ton of people are getting wrong. Okay, those have a lot of value as well. All right, so got a couple of additional that I wanted to do here, but I wanted to show you kind of like overlap in content. You know, I'm going to do a derivatives here. You know, there's two types of ways of valuing a derivative. Okay, well, first of all, you got forwards, futures, you got options, you got swaps. Okay, now if you understand forward, you're going to understand swaps because they're the same damn thing, with the one difference being forward, there's only one opportunity for a profit or loss on that derivative, whereas a swap, there are multiple opportunities. It's a series of forward contracts, multiple opportunities for a profit or loss. Okay, and then you got futures, which are just like forward, except that one standardized, exchange traded. Your futures, the other one is over the counter, private over the counter, so it could be customized. All right, those are your forwards. Okay, options. Now, options, two ways. We got relative value. Okay, what should the value of that option be given the value of other securities this company's issued? And then we got intrinsic value, rational value, your binomial model, your Black-Scholes option pricing model that we'll do in level 2. Okay, right now, this question, we're going to look at relative value, what the value of an option should be given these other securities the company has issued and outstanding. Okay, so it's all based upon what's called put call parity. So there's one formula you're going to learn that you got to know. And once you learn the one, I could come up with 7, 8 other formulas by isolating one of the variables. Okay, so the value of a fiduciary call should equal what's called a protective put. Okay, so tell me the call option, tell me the present value, the strike price on that call option. If everything is fairly priced, that should equal the price of the underlying stock plus that put option. And the option, the call and the put have to have the same strike price and the same term. Okay, both sides should be equal. If they're not equal, then I want you to sell the side, sell whatever's on the side of the equation that's overvalued, buy the side of the equation that's on the less than side, undervalued. Okay, that's one use of put call parity relative value. The other thing is we can create what's called a synthetic security. All you got to do is remember, that's the security I got to isolate. So there's only one formula right here you got to remember. Oh, you want the value of a synthetic put using these other securities? Okay, I'm going to isolate the put. I'll subtract the stock from both sides of the equation. So I'll buy the call. I'll buy the present value. The strike price, by the way, is a bond that's going to mature at the same date these options expire. Okay, and we're going to discount it back given the term of the option, okay, and what the risk-free rate is. minus the underlying stock. Anything with a minus sign in front of it, you're selling. Anything with no sign is really a positive. A positive sign is what we're buying. Anything with a negative sign in front of it is what we would sell. Okay, this is what the value of the put should be. If you buy a call, buy a bond, okay, tell me the present value of the strike price, and then you sell the stock short, that's what the value of this put should be. Okay, so let's see what we got. So notice I started with the question stem, by the way. I knew immediately what to do with the facts. So Europeans, European, how? Well, American options are always greater than or equal to the European counterpart. Why is that? Because Europeans can only be exercised when? At expiration. American are flexible. They can be exercised at any point up until expiration. So with that additional flexibility, you generally don't want to exercise early. Why? Because you pay for time value. General rule of thumb is the longer the time, the higher the value. Time value decay, theta. We'll learn about, delta, gamma, a lot of that stuff in level 2. But as we get closer and closer to expiration, time value goes down. Okay, but the moral to the story is you generally don't want to exercise early because then you wasted your money. Why'd you pay for that time? Now, there are exceptions, a deep in the money put option, or you got a call option in the money and it's about to pay a dividend. There are exceptions, okay? But that's the general rule. All right, so let's see what we got. They tell us the security is priced at 30, so we're subtracting 30. We got a strike price. Now I need the present value of that strike price. My strike price is 25. Call option is priced at 8. And the put option is actually priced at 2. So that's the actual price. We're looking for the synthetic value. Okay, so there's make-believe value given the value of these other securities, relative value. Okay, but that's the actual value. So we want to look at the actual value versus this synthetic value, which we're about to calculate. All right, but I need the present value of that strike price. Okay, so my strike price, exercise price is 25. The risk-free rate is 10. 1 plus the risk-free rate. What's the term? 6 months. So we're going to raise that to 6 over 12. So the present value of this strike price, 25 divided by 1.10 raised to 0.5. I got 2384. I got 2384. That is the present value of my strike price. Okay, so it's whether or not we're going to buy a bond or sell a bond. Okay, if you're buying a bond, you're lending money, you're investing. Okay, because remember, we always want to sell the side that's overvalued, buy the side that's undervalued. Okay, so we're going to buy a bond, sell a bond, etc. Here we're going to buy a bond, invest money. All right, so positive. So the present value of the strike price is 2384. We're going to need those proceeds when they mature to do what? We're selling the stock short. So we're going to have to cover that short position in the future, okay, in 6 months. So this is, should I do the math in my head? I don't trust myself. But let's try. 23, 30, 3184. Come on, Pete, you could do it. Minus, not 30. Why did I write 31? It says 30. 3184 minus 30, $1.84. Let's go. Let's go. So the synthetic is cheaper than the value of the actual put option, okay? So that's called relative value. That's not the logical, rational. It's just relative to, just like price to earnings, price to book, price to sales, price to cash flow. Where are you relative to the competitors? Are you relatively under or overvalued relative to the peers? Okay, but that doesn't explain anything to me in terms of the rational value. The fundamental value is driven by the factors that drive value, future cash flow, whether it's in the form of dividends, coupons, rent, terminal value, maturity value, okay, and your risk, your required rate of return, your discount rate. Okay, I wanted to show you one more, and then I got to turn it over to Chad. I wanted to show you one more because I want to show and get beautiful explanation. Love it. Okay, the last one I wanted to do with you guys, not the quant, that's too easy. That would insult you. You get very upset. I wanted to do an FSA because I want to show you why this is so important. First of all, basic EPS. First of all, notice I didn't start up here. Okay, I always start with the question stem because I don't want to reread the question. Okay, you don't know what to do with those facts until you get to the question stem. Then you're going to have to reread now knowing what to do. So we start with the question stem. Basic EPS, net income, minus preferred dividends divided by your weighted average common shares outstanding, which could be a question unto itself. Okay, you'll learn about, hey, if you see a stock, stock dividends, certain things that you're going to think, hey, we're going to retroactively apply that. The questions in level 1, are usually focused on one of the pieces of the puzzle, like weighted average common shares outstanding. Okay, some of the questions might just obsess on that. All right, so you got to know now what the way I teach it might be different from how you learned it in school. Speed is nice, but accuracy supersedes speed. So long as your way works all the time, I'm happy with it. I'm going to show you a foolproof way, okay, to get your weighted average common shares outstanding. Here it's given. All right, but generally we're going to weight things monthly. All right. So the analyst uses the following information to get basic EPS. By the way, when you have a simple capital structure, nothing that can be converted into common stock, no convertible bonds, no convertible preferred, no outstanding options or warrants, all you have to do is basic. But when you have what's called a complex capital structure, you have convertible bonds, or maybe you have convertible preferred stock, or you have outstanding options and warrants, not that are being traded in the market, that you've issued as compensation for something, to buy something. Okay, outstanding option warrants, then you got to do both basic and fully diluted. And diluted, because it's a rule of conservatism, has always got to be less than or equal to the basic amount. Because it's a rule. Good news, we wait till it actually happens. Potential bad news, we need to warn people in advance as an accountant. Okay, now net income minus preferred dividends is a subtotal called income available to common stockholders. Okay, you're then going to divide that by WACSO, and therein lies your basic EPS. So let's see what we got. We got 200,000 preferred shares that pay a $2 per share dividend. So we got 200,000 times 2. That's 400,000 in preferred dividends. 400,000, I'd like to drop the zeros. I got 1 million shares of common stock that pay $1 per share dividend. The dividend on the common stock right now is irrelevant. But the 1 million shares, did we issue any? Did it go up? Did we have a million outstanding all 12 months? So that is your weighted average common. We didn't buy back any, reducing it. We didn't issue any more. Okay. No stock dividends, none of that stuff. So the million. Okay. So that's 1 million here. So I'll put 3 zeros for the million. Okay, net income for the current year, 5 million. I'm going to drop 3 zeros. There's my 5 million. So my 5 million minus my 400,000. Now this is its own subtotal, folks. 4,000,006. If they give you income available to common stockholders, that is already net of the preferred dividend. Please don't subtract it a second time. All right, your denominator is 1 million, so 4.6. Diluted's got to be less than or equal to 4.6. Okay, if they had a complex capital structure. Now, why is this important? Because I want to look at those common stock dividends, $1 per share, relative to my earnings per share. It's really earnings per common share, 460. That gets me something very important called my payout rate. How much of their earnings did they pay out? They paid out 21.7. Now, it's mutually exclusive, collectively exhaustive. Either you pay it out or you retain it. So if they paid out 21.7% of their earnings, how much did they retain? 78.3%. Why is that so important? Back to that DuPont model. Okay, we want to be able to calculate our return on equity. Okay. We want to be able to calculate our return on equity. So I would remind you, your profit margin times your turnover. Hey, that's your return on asset. Combine that with your degree of financial leverage. That amplifies the potential return to those common stockholders. When you take that return on equity, whatever that may be, and you multiply it by your retention rate, 0.783, return on equity expressed as a percentage, therein lies our growth rate expressed as a percentage. And there's a direct relationship between growth and value, so long as it's sustainable growth. That's why we need the DuPont model. What's driving that profit margin? Profit margins are heavily dependent upon, why are they making you learn economics? Profit margin is all about competition. There's an inverse relationship between competition. So Michael Porter's 5-4, are there barriers to entry? Okay, barriers to exit, intensity of rivalry, substitutes, all that stuff you learn, okay? And then turnover, asset turnover, higher the better. But we've got to be able to get a return on that asset, right? So when you buy an asset, think about it. If you're Starbucks, how many stores do we want? Because it seems like there's a Starbucks on every corner in Manhattan and New York City. At what point do they have too many stores so that the return doesn't justify the opening of that store, right? So you don't want to have too many stores, but you don't want to have too few because then you're going to have lost sales, right? So efficiency, how many employees? If you're an airline, what's the right number of airplanes? Don't want to have too many because then they're sitting in the hangar and they're not generating revenue. We got to make sure They're turning over, creating revenue. All right. So, yeah, I just wanted to point that out. So you see the overlap again, and there's our beautiful answer and all that kind of good stuff. All right. Chad. Am I announcing the winner? I'm going to guess I am. Well, the winner is the ultimate UWorld Level 1 mock exam bundle with 5, not 4, not 3, not 2, not 1, 5 full length, not partial length, full length mock exams. We have a tie. And who won? Let's see. Liana R. and Nathan R. Now, I'm wondering, are they husband and wife? They both have the first initial the same. Maybe it was a team effort. I don't know. But they both got a score of 80. Congratulations. So you all have both won 5 full-length mock exams. So we're going to reach out to you and let you know how we're going to get those to you. And now, because you've attended, and we are so grateful that you attended, we wanted to thank you, everybody who's in attendance, 15% off the advanced and the elite courses. So scan that QR code, please. Okay, and you have earned a 15% discount because you've made the time and effort to come in today, which is only a small sample, folks. We do deep dive boot camps. You want to be on our mailing list because I'm going to do a free lecture on bonds. I'll do a free lecture just on statement of cash flows. Okay, I'll do a free lecture on equity. Okay, so free lectures on quant, regression. We pick hard topics and periodically, usually monthly, sometimes quarterly, because we do them at different levels, because we want to earn your business. You got to try it before you buy it. All right. So it's all about who's the best today, not yesterday, because what happened yesterday is no guarantee of what's going to happen tomorrow. And review courses are the same. Things change. All right. So you want to do your due diligence and find the right place for you. So again, my name is Peter Olinto. It's been my absolute pleasure. Sam, I don't know if you could take yourself off of mute, but I don't know if you wanted to say anything. Also would like you to scan the QR code for the question of the week so that, yeah, we're keeping you up to speed on different questions and hard questions that we know from our software that people struggle. Okay, and those are the questions we choose to work in those master classes and or the end of chapter questions, boy, we solve those, the hardest, not every single one, the hard ones, not the easy ones, not the definitions, not the terminology where there's a great detailed explanatory answer, but the end of chapter questions that are hard, that are a core concept, very likely to be tested. And we can do a lot of value in helping explain it to you so you get through these more quickly, so you have more time for the mundane trivial pursuit definitions. Sam, did you want to say anything? I don't know if you could take yourself off mute. I'm guessing not. All right, so that's all I got, folks. I want to thank you sincerely, everybody, for your time and attendance. Yes, I hopefully will see you in class. I'll see you in a master class or a boot camp. But whatever it is, folks, I really do appreciate your time. Although this was free monetarily, it certainly was not free in terms of your time. So we thank you for your time. We hope you earned your business. And we'd love to see you guys in class. Best of luck.